these realities. And right now what we're seeing is that in the past year, we did a lot of chartered banks types of loan, and now the gap between CMB, so securitized lending solutions versus bankers is like somewhere around 50 basis points. It's getting tighter now, but it's a huge gap. I mean, every dollar counts. So if you get a reduction in your rate by 50 basis points, you're going to go for that option, because we're talking thousands and thousands, if not hundreds of thousands of dollars in financing more. So it's going to be a reality a lot of investors are going to be facing.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing right here in Quebec. And today I'm very happy to have Stephanie Kowalew from L'Effet Papillon Financement. Hi, Stephanie. How are you?
I'm doing very good. Yourself, Axel?
Very good. I'm quite excited. Got a bunch of good projects that are on their way. It's just always a bit slower than I would have liked, but I have to deal with my impatience. It is what it is. So today, you've been on the podcast before. You're an expert in commercial financing. We've actually done some files together, and always been very happy with everything that you've brought. And so there's so much happening right now in terms of financing and credit, and so I thought it was a good idea for you to come back, because there's a lot to share given the macroeconomic environment that we're in right now. So before we jump in, I just want to remind everyone, thank you for your support. Please share this episode with someone who could benefit from this conversation. Subscribe to the show, send us some feedback. I try to respond to absolutely everything I get as quickly as possible. There we go. Now, Stephanie, the Bank of Canada has increased their rates. There's a tightening of credit. Let's be honest and transparent. And we also know that there's going to be more interest rate hikes before the end of the year 2022. So from your perspective, like, what are you seeing on the market right now?
Yeah, so it's really interesting. What we're seeing on the market is, if we look at the Bank of Canada, their announcements since January, we're talking about an increase of 75 basis points, so 0.75%. But if we're looking at, for instance, Canadian mortgage bonds for the past year, we're talking about over 200 basis points, so over 2% increase. So basically what I'm seeing, and that's even worse if we look at cost of funds for banks, we're seeing an apprehension in the market, and I'm hoping that it's already priced in. But it's a free-for-all. Inflation is through the roof. It's an interesting market to be in. However, whenever it's an interesting market and the market kind of reacts very strongly with fear, there's a lot of opportunities.
Yeah.
So it's interesting. It's a very difficult market. I think we're not used to it. But if I can say my 2 cents of words of wisdom, is what we've been seeing for the past couple of years is not a normal market. What we're going to go step into is just more of a normal market. Just in my area, we were talking about 15-17% property valuation increase year after year. Like, that's not normal. That's not making a younger generation capable of buying real estate. So I think we're going to go back to normal, and it's very needed in the market. So it's an interesting market.
Yeah. And so just to go back for listeners, like, over the last 2 years, the government and the Bank of Canada wanted to support the economy so we wouldn't go in free fall, and injected a lot of capital in the economy. And so now there is almost too much capital, given that we haven't really increased our production, our goods, and our GDP. And so now money's almost become too cheap, which has pushed asset prices. And now, in order to deal with this, the Bank of Canada is slowly increasing the price of money, which is the interest rate. So we've benefited for about 2 years of very low rates. And now, when you say we're going back towards normal, what do you feel is a normal interest rate that we should be anticipating in the next year or 18 months?
You're asking me an awful question.
Yeah, I shouldn't.
I can't answer that. Nobody has a crystal ball, and economists year over year have been completely wrong with, estimated what the interest rate. So I really genuinely cannot comment on it. But I think what people should do is prepare for the worst, do a lot of stress testing, 5, 6, some bankers are even starting to use 7%. So exactly what the inflation is at in their stress testing and sensitivity analysis. So what I would say is prepare for the worst, and you'll be fine. And so I think that's the best way without it having any idea of where the interest rate, but the best way to control an economy is through interest rates. So, I think the Bank of Canada is doing what they need to do right now.
And, as I hear you say that, thinking about the stress test, indeed, it's very important. I'm about to launch a financing for our largest projects, and that's something that I keep in the back of my head, thinking like, wow, it's actually, I wouldn't say it's an awful time to be doing this, because there's never a good time or a bad time. It's just you have to deal with the current economic situation, but it's definitely going to be taking more capital than originally anticipated even a few months ago.
Yes, and if you look at fundamentals, like especially where we invest in multi-unit, it looks good. It's a very recession-proof asset class. So I'm not too worried. There's a vacancy rate that we've never seen before. There's a shortage of supply. There's a huge chaos when it comes to construction. We're not able to just respond to the current demand. And that's even considering that for the past couple of years, immigration has been very little. So now bring that back. I mean, I think we're in a pretty bulletproof investment class. So I'm really looking forward. But, some municipalities are imposing certain things. There's also legislation that's in place. So there's certain things to consider in there. But I'm pretty optimistic. And the only way you can, you just have to focus on what you can control. And what you can control as an investor is your rental rates, especially if you're doing construction and new construction, and your expenses. So we see a lot of creativity when it comes to expenses, optimization opportunities. Internet is something that's becoming more and more common. So there's a new APH Select product that I think you've spoken a lot on the podcast, but a lot of energy efficiency programs are super interesting for older buildings that need some loving. So there's a lot of opportunities. You just got to stay open to them, and prepare in some ways for the worst through your stress testing. Use a higher interest rate, a much higher interest rate, and be a bit more creative when it comes to your revenues and expenses. This is where you're going to be gaining basically all of the losses through the interest rate.
You mentioned the APH Select program, which is a very good a program that was put in place about that really started about 2 months ago now with the CMHC, March 7th. Let's take a few minutes to talk about it. Can you kind of describe the program and some of its advantages?
Yes. So the programs have three main components. You could have a little bit of every one of them or just one of them. So the main three are accessibility. So, and then you have energy efficiency and affordability. So those are the three components you can have fun with in your numbers. What we've come to analyze is, for when it comes to existing properties, it could be interesting to focus on energy efficiency. While as for new construction, it's a bit harder to be getting. So people tend to focus on affordability. Accessibility, I would say I have yet to figure out this part. It's a bit not clear to me. And even with architects, when you speak to them, so that's still to be determined. And I think it's still to be there's a lot of work to be done in the planning for those units to have access to these points. It allows up to 50 years amortization, which
Wow.
is incredible. A much lower premium. So if we have because it works through a point system. So if we have the highest points, which is 100 points, it allows for a 50-year amort and up to 50 years and a 1% premium.
Mm-hmm.
So if you're talking new construction, 40 years amort, in the old program, we're talking about a 5.25% premium. So significantly reduced. There's a bit of a higher premium for when your effective gross income hasn't been reached for new construction or projected income performance. But all in all, I think that's the reduction in premium, much higher interest rate, and basically the program could not have fallen in a better
timing.
Yeah, it's incredible. Really, really incredible. It's a relief for most, or if not all, of my clients.
Yeah. And as just to give a bit of background, as we expect obviously rates to increase, that means that there is more and more down payment that's required to buy the buildings. And so this program allows, given the number of points that are achievable, up to 95% that can be financed. Is that right?
Exactly. For new construction, 95% loan to cost, and for existing buildings, 95% loan to economic value or loan to purchase price, and adding the cost if you're going to do energy efficiency. So it's interesting. I mean, the numbers got to work, but it is feasible.
Mm-hmm. Wow. Okay. So, and this program started about 2 months ago. I bet there's been a pile up at the beginning. Everyone got really excited. Have you seen already some files being approved and moving forward to
yes,
institutions?
So we have a few files. We were one of the first ones to be submitting deals, and within a month, CMHC was able to turn around and issue certificates for clients.
Wow.
So the turnaround time is a lot faster for APH Select than standard CMHC, so that's pretty positive. I find they're faster now, like they're faster than they were a year ago. So that's really good news. But from the moment you submit and you have all your documents aligned, I would say they turn around currently, which is, we're talking in May, within a month. Okay. You're going to get an underwriter and then maybe another week or two to underwrite. But we have to also consider, like, eventually vacation is going to start.
Yeah, so it's going to be the summer.
Delays are going to be. So we always have to look at those things when we're submitting. But I would say within a month, they turn around these days.
Wow. Okay. Well, that's really good news, and that's going to be a great new tool for investors to deal with the current environment. Where, yeah, I think we should really prepare for a tightening of credits, which makes sense because the last 2 years have been I don't want to say la la land because I benefited from it, so I wouldn't, who am I to spit on it? I'm extremely grateful and thankful. Is that we have to now get in our minds that things are going to be a bit different.
Absolutely.
Mm-hmm.
Yeah.
So for investors that are coming on now, and I was talking to someone this morning, he's looking to buy his first sixplex before the end of the year. When it comes to financing, what advice would you give in terms of preparing the file and dealing with higher stress tests?
It's a really interesting question. I mean, it depends on the type of investor, but if it's somebody that's looking to really be full-time in real estate, because there's, part-time investor that just, want a return on investment and that's it. But what I'm going to be speaking to is really people that are looking to move more full-time into it. I think optimization, so properties who need some loving, even if you're going to go private or alternative lending when you buy, if you can turn around the property within 6 to 12 months, especially with energy efficiency, I think those are the opportunities I would focus on if you have the ability to deal with the stress that comes along with managing a construction team and managing a project that is not simple. So I would say, don't hesitate to buy conventional or even with alternative lending solutions. If your exit really, really makes sense, say you've stress test at 6-7%, you have projected rents that are where the market is supposed to go, I would really focus on those properties, because focusing on energy efficiency is I think for these types of investors, they're going to get the most equity takeout out of these deals. Obviously, properties that have the tenants paying for hydro and heating, but converting to the tenants paying for those services. I think those are already big winners. But again, trying to control, there's only so much you can control, your revenues or your expenses or both. Finding ways, adding lockers in underutilized square footage in the building. Just anything you can possibly do that is cost efficient and you can get $50 a month for. So just looking at your square footage, try to optimize as much as possible. And the two things you can control, your revenues and your expenses.
Yeah. And I guess that's a conversation that you have with when your clients. You founded the l'effet papillon financement. It's been what, a year and a little bit more?
Yeah, a little over a year ago. So I've been in the industry as a broker for 8 years. And I started my company a little over a year ago because I just felt, and that's the thing that I'm realizing now, that we're going to be coming to, some people are going to call it a recession. Who knows what's to come, but there couldn't have been a better timing for me to start the company, because when these tougher times happen, the banker you've had for the past 20 years is starting to say no to you. And so you turn to alternative, more specialized workers to help you lock in your financing. So, I mean, it was a good move.
Definitely, it was a good move. And so what's your ideal client profile? Because I know you're very, very booked, and now you've become quite selective on who you accept, and I find that says a lot about you and how you want to work. If, let's say, if someone wants to reach out and stuff, like how can they maximize their chances that you'll accept to work with them, basically?
Yeah, it's a good question. So we are extremely selective. So our client profile is people that are going full-time into real estate, multi-unit investing, ideally over $1 million in loan amount initially. So that's really the clientele that we're going to be, that we are focusing on, and anything below this, or we are there to close deals. We're not there to educate people. So sometimes the answer is going to be, well, go to this school or go take a 6-month course with this person. So we're always open to picking up the phone when people want to get in touch with us. But really, investors that are really going full-time into real estate, minimum loan amount for multi-unit $1 million and up, and ideally they already have a multiple buildings, whether it's multi-unit or not. And looking for optimization or new construction project, we're really good at that too.
Okay, that makes sense. And it's as you said, like, given the kind of change in the overall environment, the importance of relationships that people have been able to build with others makes a huge difference. And I love the example of, well, you've been working for a banker for 20 years and all of a sudden now he starts to say no. It's not that he doesn't like you, it's just that he's getting guidelines from higher up that says, hey, now we're tightening, those are the credits, and if those are the criteria, and if they don't fall into it, then we may not accept them. So the importance of relationships and being consistent and actually doing what you said you were going to do becomes crucial.
Exactly. And it's going to be, people are going to face reality within, these realities. And right now what we're seeing is that in the past year, we did a lot of chartered banks types of loan, and now the gap between CMB, so securitized lending solutions versus bankers, is like somewhere around 50 basis points. It's getting tighter now, but it's a huge gap. I mean, every dollar counts. So if you get a reduction in your rate by 50 basis points, you're going to go for that option, because we're talking thousands and thousands, if not hundreds of thousands of dollars in financing more. So it's going to be a reality a lot of investors are going to be facing.
You mentioned the CMB. Can you just elaborate a little bit more exactly like what it is and what it
Yeah,
means?
so it's the Canadian mortgage bonds. So
Mhm.
it's not publicly available, but you can follow in the Bank of Canada. You can look at mortgage bonds, and it's closer to the 10 years if you're looking at the 5 years. And basically, you can track the market. So Canadian mortgage bonds is going to follow that direction, but it's not publicly available in terms of pricing. But basically, a lot of the lenders, we're going to call them online banks, use CMB pricing. So they're going to use CMB plus whatever spread. And then if your broker uses a spread in that, they're going to add another amount of basis points. So it's basically how we quote the deals. And yeah, this is basically Canadian mortgage bonds. You can follow it on the Bank of Canada, at least the direction, and it's going to give you a good idea.
Okay. And so you would advise people to kind of shop more between like the top 6 banks in Canada and some of those alternative B lenders?
I mean, as in May, there's a huge gap. It looks like it's, tightening a little bit, but you should keep yourself open to alternative options that could be benefiting you in terms of pricing.
Mhm. And just off the top of my head, I'm thinking of MCAP, but there, I think
Mhm.
for much larger financing, there's also Equitable Bank.
So Equitable is starting to open up the door. They're going to focus more on new construction from what I'm hearing. There's People's Trust. There's also other like CMLS that is also out there. There's Peak Hill, who's new in the market. And these are the types of banks, online banks, that are only usually doing business when there's a broker involved.
Involved.
So because they don't have necessarily the back office to support the kind of servicing that it requires, to deal with these types of online banks, you have to go through a broker, usually.
Okay. And hence they can call you.
Exactly.
Without being said. Okay, well, that's good. And at least it gives a little bit more of option because obviously, we'll see what the future hold, and no one has a crystal ball. So it'd almost be fun to, come back in 3 months and we'll see how it's evolved, right?
Exactly. You need to post for the 13th of May, post it on the 14th of May.
Yeah, exactly. Because 2 weeks from now, that information will already be old. Yeah,
Exactly.
there's so much there's so much happening. Okay, and then another question that I had for you is that obviously the CMHC launched their new program, and we just talked about it a little bit. Has there been any changes or indications of the fact that when people refinance, they have to reinvest into real estate? Do you think that's going to be removed at some point, or where is that going?
I personally think, like, when you understand why it's there, like, we have to look at, so this is just a criteria for CMHC insured loans. So it's a
Yeah.
policy. I don't see it going anywhere anytime soon. I think it's there to stay, and for all the right reasons. So CMHC's target to make, housing available for every Canadian by 2030, this clause is not going anywhere. And I think it's great.
Mm.
It pushes people to reinvest in real estate and provide more housing. So I think it's a wonderful clause. It happened at the right time where there was a lot of liquidity
Yeah.
being taken out. And so I think it was a really good call for them to do
Yeah.
that.
Yeah.
And so basically the clause, I don't know if you want to talk about further about the clause and what.
Sure.
Okay, so the details of it is just when you go and refinance, so take out some money, you're going to pay off your current lender. It needs to be an approved lender. And then whatever equity takeout is left over, say you have 200,000, well, you will have to put that 200,000 either reinvested back into real estate, 2 units and more, either new construction or existing, reinvest in your current portfolio, 2 units and more, or reinvest in the subject property. So those are the main clause of that. And I think it's just was a really, really good call. And I've been really impressed to see CMHC for the past 12 months with this clause that came maybe 12 months ago. They really could see what was happening in the market. They took decisions, and now APH Select, like, we are like the Canadian government. If you look back at the global financial crisis of 2008, like, were we really affected? I mean, not really. So I
Not as
think
much as other countries.
they're making very bold moves, and I think like we are very well handled.
Yeah, no, totally. And going back at it, I remember when that announcement was made and talking about it with another experienced investor, and he basically said, yeah, it makes sense. They just don't want you to, refinance, take that money and go buy a boat, because a boat does not create housing. It doesn't support the cause, and that's pure consumption. And that's exactly what they wanted to prevent, is that, yeah, the market's been increasing very rapidly, but it forces people to keep reinvesting in the same domain. And the mandate of the CMHC is very clear, is to open housing to all Canadians. And you're right, it was a very good measure that they put in place.
Yeah, absolutely.
Okay, so see, sometimes like in having these conversations, I feel like when you talk to other people in other countries, I feel like I don't want to say we're blessed, but the Canadian system and financial institutions, the Bank in Canada and stuff, like, I'm not an economist and I'm not going to say whether they're doing a good job or not, but I find they're creating a very good environment to support the direction that they want to go into, basically. Yeah.
Absolutely.
Yeah. I'll put it out there. I'm an immigrant. I'm so grateful to be in Canada. Thank you. And I want to contribute back. So anyways, that's my 2 cents on it. And by the way, that reminds me, because now I'm thinking of like, the US. I have a friend, Nathan Turner, who invests in notes in Canada, well, in the US, but he's Canadian. And he was telling me like how great of an alternative method it is to invest in real estate, because we always think of a rental property, but you actually need to manage it. Whereas he buys mortgages, and he says, look, it's the same thing as getting a $1,200 rent, except I don't have to manage tenants or toilets or anything like that. And he's actually holding a training beginning of June 3rd and 4th. And if anyone is interested, actually, they can find out. His website is the CanadianNoteGuy.com/events, and he's doing a training. And anyways, that conversation has been really interesting. He was on the podcast a couple episodes ago, and I highly encourage you to go and listen to it.
Awesome.
There. Yeah. Well,
yeah, that's another way to look at it. Absolutely.
Yeah. And that's what I love about real estate. There's so many different ways to invest. And like, I'm thinking of people who do short-term rental, those who do optimization of multifamily, those who invest in nodes, those who do some land banking, and there's, or rent to own. There's so many different ways to be contributing. And the more it goes, the more I think we all feel like we also have a moral and social responsibility that we do provide housing. And I take it very seriously, because it's for us, it may be an investment, but it's where people live. And that's to be taken with a lot of gratitude and cool-headedness.
Exactly. And I think the old like model of just like being super overly greedy and kicking people out, and like, I just don't think it's a strategy that's going to work anymore. Like it's just, and if you look at, I mean, statistically, I haven't looked recently, but the turnover is around 20%. So within 5 years, your building is completely renewed anyway. So why be aggressive in doing that? Just prepare it in your numbers. And, like, real estate is like, yeah, you can look at the finance world and think, okay, it's very empty. But when you bring the real estate component into it, like, families are raised in real estate, like, just couples are made, marriage, divorce, sometimes, like, it's just so full of life that we have to remind ourselves that when we are lucky enough to be in real estate and we're passionate about it, like, those are very good core values to have when you speak to tenants, when you deal with the people that are involved in real estate.
You're absolutely right. And we allow for memories to be created. And because they lived there when they had their 4th birthday party, and they had big life events and stuff like that. And that's sometimes like part of the social aspect of real estate investing that we don't talk about often. And that I'm glad we're mentioning today, because it's a good reminder for everyone.
Yeah, absolutely.
So Stephanie, you've been on a roll for over a year, starting the company. Where can people find out more about you?
Yes, so my contact information are going to be in the podcast, so you can look at my website. So that's going to be in the link, and you can shoot us an email, book an appointment with us if you have a specific property you want to talk about. And yeah, those are all going to be information. So our website or just a quick email is more than enough.
Okay, wonderful. Well, if you have any questions, reach out to Stephanie. And in the meantime, real estate is a marathon. It's not a sprint. Keep researching your market, make some offers, get educated, learn, talk to others, network, and good things will happen if you put in the work. And if you put in the work, Stephanie's a fabulous testament of that. So if she can do it, you can do it too.
Absolutely.
Stephanie, it's always a pleasure. Thank you for coming on today. It was an honor to have you on, and I like the conversation that we had. And you'll definitely come back in a few months to give us a bit of an update and see where we're at and stuff. That's a great development.
All right. Well, thanks for having me.
No problem. Thank you very much for listening. Again, if you think this was a good conversation, share it with a couple of friends who could benefit from it. And in the meantime, again, research your market, make some offers. Stay tuned for next week. Thank you.